If you're fishing for stocks to invest in or to short, and you pull one out of the water, you have to ask yourself, do I keep it or throw it back? There will never be an absolute formula because things change and evolve over time, but here's a helpful analogy and a few tools to look at for your consideration. Anticipating the direction of a company's stock price is like watching a hot air balloon contest, where participants are judged based on how high the balloon gets, stays up, and how far it goes. Also, each participant builds their own hot air balloon and submits the blueprints for everyone to see. So I can look at the mechanisms inside the balloon, like the fuel the balloon uses. I can research the history of the operator of the balloon. I can also look at the weather patterns and notice when the balloon is higher than it should be or lower than it should be. I can most accurately anticipate and profit from balloons or companies that are about to undergo significant price changes. First, let's look inside the mechanisms of the balloon. We might look at the financial statements and look for the rate of growth for the revenue. We might look at the quick and the current ratio, which measures their ability to pay their bills. We might look at the free cash flow, which roughly is leftover revenue after covering the operating expenses. We might look for anomalies in the balance sheet, like a large sale of an asset to keep the net income high. Or maybe new stocks were sold to pump up the balance sheet. Also, a smart investor will see how many managers of the company own that stock. However, the biggest opportunities for fast-moving stocks is to look outside the balloon. If the tech industry is pumped up, it's like a large gust of wind blowing up on a group of hot air balloons. Then you'll see some companies whose mechanisms don't justify its height. So when the gust of wind stops, the balloons will fall, some farther than others. Or there might be a warm front pushing several balloons down who should be a lot higher. And again, when the warm front passes, they'll move to their natural height. To look for those hidden forces, watch the news. Pay attention to what's going on in the industry and how people react to the news. By this, I mean the price movement of stocks immediately after the news. Look for the multiples or the measurements for how expensive a stock is. It's a measurement for how expensive it is because it compares the fundamentals with the price of the stock. PE is the price to earnings. Price to book, the price compared to the net assets. Price to revenue, price to free cash flow. Of course, these multiples are based on its revenue yesterday, today, and projected for the next year. But investors look for the long-term expected revenue. If a tobacco company has great sales, but there's about to be a massive 300% tax hike, its future revenue will be affected, and its price will fall, so it'll have a low PE. Or if the company is in a massive growing stage, its PE and other multiples will be high because of the future expected earnings. The key is to look at the price and determine how long it'll take for a company to make enough to justify its current price, and are there unaccounted for risks between now and then before making enough to justify its price. So if there's a company that's making flying cars called DeLorean Inc., and it's $200 a share, and has a market cap of $750 billion and a PE of 150, is it a good investment? Well, market cap refers to how big it is. It's the number of shares multiplied by the price of the shares. And a large cap is 100 billion. So at 750 billion, it's huge. And a PE of 150 means for every dollar you invest in, you're chasing $1 of earning. Of course, it's a growing company with a ton of potential, but does it have any competitors? Will it have competitors by the time it's profitable? Will there be problems with the CEO of the company, or will there be issues getting enough material until it's profitable? It's very unlikely for a large company to turn its profits around within a few years to bring the PE down enough because of its size. It's like a small boat making a 90-degree turn compared to a massive cruise ship making the same turn. So in this scenario, I'm not buying the stock, and I would look into shorting it or buying put options to profit from it going down. I hope these analogies give you some perspective and help you determine whether or not you should invest or short a company. Thank you for your time, and remember, I made this channel for my friends and family. If you're watching this and you aren't my parents or siblings, then you're a friend, and I'm posting this for you. Please like this video to bless the YouTube algorithm, and this can be shared with more friends. And please subscribe, because I will post videos about opportunities I find to help you grow your money garden with steroids. Have a great day.